Welcome to the Woody Creek Apartments strategy session with myself, Pete Schnepp, and Mike Escobedo. Mike, are you present in there?
Hey Pete, how's it going?
All
I'm
right,
here.
good. So we are going to walk through quite a property that we've got here. We're going to go through all the details, the ins and outs, flip through. Thank you for joining us. If you've got any questions along the way, go ahead and plug them in the Q&A section down below, and we'll be monitoring that along the way and answer when appropriate. All right, so let's flip through here. Before we get any started, a quick disclaimer. This is listed as a 506C offering, which is available for accredited investors. If you're not familiar with that term, you're welcome to look it up. But essentially, there's three different ways that you can qualify according to the SEC as an accredited investor. One is through certain financial advisory licenses. The next way is if you have a net worth of $1 million or more, excluding your primary residence. And the third way would be income based. If you file taxes and claim $200,000 of income filing single or $300,000 filing jointly, that would be the third way that you can qualify as an accredited investor. And in order to invest in this deal, you have to be considered accredited. Otherwise, every investment is just that. It is an investment. There is a chance to lose money. And we advise that you review any investments with your financial advisors, tax planners, so on and so forth before committing. Okay, let's move on here. So, Mike and I purchased this property a few months ago, and we raised some capital to get started. We're happy to share where we're at on that. This is tranche two, and we have, we've got some proof of concept that what we planned originally works, and we are exceeding expectations. So we're excited to share a little bit more about that. Quick summary on the investment. It is a 24 unit property just outside of Chicago, but across the border in Schererville, Indiana. And 24 units, large units, two bedroom, two bath, 1,350 square feet, lots of cool features. These are not cookie cutter units. These are really nice, high quality product. And there's a lot of upside that we're going to share a little bit more about. Let's see here. Okay, as far as the offer highlights for investments, we've got a few different investment tiers listed here. Investments start at 50,000, they can go up to a million, and different class profiles have different return profiles as shown here, and we'll get a little bit more into those a little bit later on. We are intending a hold time of 5 to 7 years and a total capital raise of just over $2 million. All right, so a little bit about us. Myself and Mike are the managers of this property, and my company is Asset Stream Properties. At the moment, we own and manage about 25 million in real estate. It's about 25 properties and 150 doors, give or take. Eight of those assets are in infinite status. And overall, we have a conservative approach. We usually keep a pretty fair loan to value ratio across the portfolio. And we always are just looking to strategically redeploy capital as needed, whether it be selling or refinancing, and just the velocity of money, keeping it growing. Um, let's see. I also own another company called Envision Service Group. We do painting and roofing right now, primarily in Phoenix, Arizona. I've started and sold a pest control company along the way. I've been a licensed real estate agent since 2007. I've got an extensive construction background, working for some large home builders, building not only homes, but entire communities in the Phoenix area. I became a #1 best-selling author a couple years ago. Inc. 5000 nominee with my other company. And, I spend my time as an investor and an entrepreneur looking for deals and looking for great partners to partner with. This is my team right here in Phoenix. So we are an asset management company. We outsource property management, but we do a bunch of stuff in-house. We've got a little bit of staff here. It keeps things moving forward. Mike, you want to share a little bit about yourself?
Yeah, absolutely. Thank you, Pete. It's hard to follow up with that track record. You're a great partner to have. I'm glad I partnered with the best. But like Pete, I am also a commercial real estate broker. I've been doing that for over the last decade. I still do it. I've sold over 250 million in sales, mobile home parks, multifamily, triple net, and had a very successful career at Marcus and Millichap. But I'm sourcing deals with Pete. We're out looking for multifamily deals, so that's what we're doing now. I have had a lot of experience and background in management, and also have a lot of background in remodeling, um, homes, single family homes, things like that. So that's what I bring to the table. I have the experience and the knowledge when it comes to pushing some of the contractors, finding contractors, hiring the personnel that's capable of going in there and remodeling all the 24 units that we're looking to do here with Woody Creek. Um, Besides that, I've had a quite extensive, wrestling background in college. That's what I came from. That's why I know how to work very hard and stay disciplined and persevere over a lot of things. And that's what I'm going to be doing, boots on the ground in Cherville. So I have moved from Arizona to Cherville. So I'll be overseeing all the operations, the planning that Pete and I are doing behind the scenes here in Indiana. I wanted to get up close and personal and make sure everything's being ran effectively and efficiently. So, um, but I am here in Indiana and overseeing the project.
Cool. Thank you, Mike. And not to mention, you are two-time state champion, right?
That's right, two-time state
In
champion
wrestling.
and
Awesome.
Michigan State grad, varsity
There you
letter
go.
winner there.
Cool. So look, together we're a winning management team. We've reviewed our personality profiles before we came together, and we complement each other's skill set. My team, we've got the back end covered, the analysis, all of that. Mike's the boots on the ground. Together, we just work really well together, and you'll see soon enough about how we're already over delivering on what we thought we could. Let's see. I'm gonna move through here to the offering. So, a few highlights about what we've got here. We've got seller financing, which in place, which is one of the unique benefits about buying, call it a small or a mid-size apartment unit. You can't get these when you buy a 200 unit property, right? And so, Mike found this deal actually cold calling. We bought this directly from the owner. No negotiated seller financing. She had owned it free and clear. And what that means to us is we got really, really great terms. Our interest rate starts at 3.25. It's got a step up over the 6 year term, but it ends at what is it, 4.5 or 4.75, Mike? Yeah.
Yeah, 4.5%.
4.5. So it's a blended rate at 3.88, which is amazing right now. And what it means is we've got a really low mortgage payment considering the amount of rent that comes in. So there's plenty of cushion there on the spread. To give you an example, our first month of ownership, we brought in over 40,000 in income. We hadn't done anything to the units, and we had two of the 24 were vacant. So we had 40,000 in income. Our mortgage payment is just over 11,000. So there's almost $30,000 in spread. Clearly there's management fees, there's expenses, but it's not that much. That's with two vacancies and before we even began our business plan. So just to show you the power of a low interest rate. Strategic value add opportunity. Like I said, these units are really nice already. They just need strategic cosmetic improvements, and they were drastically under rented compared to the comparables in a market that has really strong demand and low supply. So when we bought these units, they were renting for about $1,500 a piece. We clearly saw that the rental market was more like 2,000 to 2,500 with some comps nearby, and so that's what we're delivering. A couple other highlights. We've got a pretty flexible exit strategy. The 24 units were bought as a portfolio, but they're actually deeded as individual fourplex parcels. And so I think really we plan to sell it as a portfolio. However, there is the option to sell them individually. And as an investor who's bought fourplexes, I know that the best rate that you can get on multifamily is on a fourplex is because it's considered residential. And so you can get a 30-year fixed, a true 30-year fixed on a fourplex at a really good rate. Whereas commercial financing, generally you're going to be limited to a 5, 7, or 10-year term. So it's in our back pocket to explore when the time comes. And overall, the financial projections on this property are really, really strong when you factor in the basis that we bought the property for, the cash flow, the lift that we're doing. It's all really, really penciling out very nicely. So the business plan is simple, right? It's just to go in and make some improvements and bump the rents to the market rate. We're not really getting too aggressive on them, and we've already executed on that. So our target rents in the pro forma were 21.95 a month, and the first unit already rented at 23.95. The second one rented at 22.95, and we just got the third one rented for 2,500. So things are in motion. We're outperforming. Um, let's talk a
Yeah,
little bit.
Pete, and that was a pre-lease too, not to mention
The
that
third
was
one,
leased
yeah.
up
The unit
before
is
we
still
even
under
finished.
construction,
That's
right?
right.
Yeah. So some of the benefits that people really like about these, and honestly that drew us, that we knew that people were going to like, is these are large units, 1350 square feet, two bedroom, two bath. Like this is the size of a single family home. They're really nice, really spacious. You'll see some more pictures as we flip through. The upstairs units have beautiful vaulted ceilings with beams. They've got big decks. They open up to what's called Woody Creek. It's kind of a nature preserve area, great views, modern kitchens. They've got garages, a lot of little touches that you just don't get in apartments. So here's a quick video walkthrough of one of the units before we did anything. You see the carpet, but it's a nice layout there. The property was built in 2012. Here's an aerial view. And so these are the properties right here. And this Northwest Indiana area, part of the reason why we like it is the location. So it's 40 minutes outside of Chicago. So here we are in Shearville. Chicago's over here. South Chicago is maybe 35 or 40-minute drive, but it's considered Chicago land. And so it's considered a suburb, but it's across the border in a much more landlord-friendly state. It's also, about an hour, hour and a half from two major universities, Notre Dame and Purdue, right? So we're going to jump into some market analysis, which we definitely did a very serious deep dive on this prior to, finalizing our earnest money with the seller, right, Mike? We wanted to truly understand the dynamics out there. This is a totally new market for me, and Mike was trying to tell me a little bit about it, but we deep dived into this, and ever since then, we just keep getting great stats about the Midwest, about Chicago in general. This whole region is really outperforming most other regions in the entire United States for multifamily. And so we almost daily, definitely every a couple times a week, we come across new articles that just support that what we learned when we started looking at this property at the end of last year, right? So number one, the occupancy rate out here, we did another study, you'll see, historically is 95% or more in this area. Okay, and if you're in Phoenix like I am, or most other markets, right now you're not at 95%. You're probably lucky to be at 90%. Rent growth from May was over year from May was over 4%. And I know another stat nationally that I've seen is nationally as a comparison is under 1% year over year from May 2024 to May 2025. Chicago area is 4%, nationally is 1%. Days to rent stat is 39. We're renting these a lot faster. We saw a stat that applicants per unit in this region is 10 applicants per unit. And Class A price increase, I don't know what this is compared to. I'm guessing from last year, 33%. Here's some more information about just comparing region to region. You know, Chicago, this whole area just did not get the oversupply in apartments built like most other regions did. This stat came out actually yesterday or today. As of quarter two, Chicago's effective rent was up 8% from last year, reported by Mercadia, compared to 1% nationally. So this Midwest area, this Chicago area, it really is just, it comes down to the fundamentals. There's consistent demand and there's not an overbuilt supply like most other markets have gotten. In terms of home price, now this is not rental growth, this is home price growth. Here's some other stats. Chicago metro growth over 5% compared to US, which is 1 to 1.5%, right? May, April, March. Mike, you've kind of experienced this yourself just looking for a place to move out there, right?
Yeah, I was actually going to interject and talk about this specific this momentum that you're talking about. It's definitely a different market from Arizona, where you and I are from. Super hard to find anything to rent. My actual mortgage lender actually had around 70 clients that he was working with. I said that 70 that were filing to buy more homes in Northwest Indiana. It's that
That's
type of
crazy.
market. Yeah,
That is not
yeah,
happening out here at
it
all.
is not. It's that
Wow.
way. So these stats are accurate. It was a tough time to find a house. It was a tough time to find rentals for me. But yeah, it's definitely looking like the Midwest right now is a top target.
Yeah. Right. And so with that, I mean, there's been a lot of stats about institutional capital really just moving into this region, into the Midwest region. And there's two big players. One of them committed $500 million. The other one was $300 million. I have the stats on a different in a different area, but there's $800 million just in the last, you know, 3 or 4 months, maybe 6 months that have been committed to multifamily investment specifically in the Midwest region. So it's not just us that saw this that are looking at 24 units. There's big players coming in. And what that's going to help mean for us is liquidity and durability essentially down the road, right? Um, you know, this area out here, it's a strong area. So we're on the outskirts of Chicago. We draw in the Chicago workforce. Schererville is kind of an affluent little neighborhood, but it's a transportation hub. There's like, what is it, 3 or 4 highways that run through there, or like major thoroughfares, right, that connect Chicago from other parts of Indiana. There's
Yeah, you've got US 30, US 41. Those are the crossroads of the nation. Those highways, they go across the entire nation. You can travel the US 30 east and west all the way across the United States, and 41 north and south across the United States. And then you have the 80/90 and the I-94. Those all intersect. Super easy exchanges to get to Chicago.
right. Yeah, so it's a thoroughfare. You've got good employment. Local hospital, there's a big employer. There's this manufacturer that's a big employer, and but really, there's a lot of people working in Chicago that come out here. Some cool stats that we found: Schererville is outpacing U.S. future job growth by 30%. The area itself has a lot of development funds that they are doing to redevelop the local area and their downtown. And it's a cute little area, like nice neighborhood. They've got, you know, Whole Foods is out there, BMW, Mercedes-Benz, Cooper's Hawk Winery, you know, a lot of the stuff that you would expect in out here, you know, you see in Scottsdale or that you would expect in any other, you know, affluent area, you see in this little town. but paired with the nice benefits of like the local mom and shop Italian eateries and stuff like that, right? So it's affluent, but it's affordable compared to Chicago. And what we love about it is, hey, in Chicago, somebody's going to rent a similar apartment or condo, they're going to be paying 3,500 bucks or more to live in Chicago. Whereas coming out here, it's 2,500 bucks or less. It's a steal of a deal, right?
Yeah,
For
and
that.
Pete, just to share with the guest here on the webinar, I did walk a family through one of our units personally. They came from LaGrange. They were renting well over 3,000 a month, and they came personally to come visit our location. They had no idea of the amenities that were nearby. And when I had the chance to talk to them and tell them, hey, you're in the middle of really all the amenities with Woody Creek. You've got Whole Foods, you've got Nordstrom's, you've got Home Goods, Ross, the movie theater, Showplace, DSW, Skechers. I mean, it's literally just 5 minutes down the road. Our hardware store, if we need to get anything for the property, it's literally just I could throw a rock at Menards. It's right here, right down the street. So if we're repairing something, it's right there. We've got Home Depot just around the corner. We've got fast foods. We've got car dealerships. We've got Carrabba's, Dave's Hot Chicken, Noodles and Company. It's literally right here around the corner. So it's so convenient for folks to be here when they realized that and they understood that they're only paying $2,500 a month to get more amenities than being in Chicago or LaGrange. They literally pre-leased the property.
Yeah.
So that's what we're dealing with. That's the location that we have to offer for the folks.
Yeah. And what I like, right down the street from us, there's this big park. I forget what it's called, but people are over there hanging out. They've got benches just to like sit there and watch nature and birds. People are walking their dogs. It's a cool spot. Um, Shearville itself, in Indiana, it's a low crime area, super safe. The accessibility, which we talked about. If you're flying in, usually you want to hit Midway Airport. That's the closer one, right? Um, yeah, and then you've got Lake Michigan right up there. So I remember when I was there talking to residents, they say they go up there for vacation. That's the vacation spot. 2007 named this area one of the top 100 best places to live in the United States. Small town Indiana, right? Good schools. It's just a nice culture out there. And it's consistent. So, the Midwest is kind of like a steady eddy. It's not really ever overbuilt. There's always a little bit of increasing demand, and that just means steady appreciation, steady inflation, steady rent increase, steady. You know what I mean? So the last 10 years, 2014 to 2024, home values went up an average of 5%. It's nothing super sexy, but it's reliable and consistent, and you can count on it. And that's kind of what we're looking for in investment. To me, this means it's safe. You're not going to get the big fluctuations that you're going to get on the coastal markets or even that you get in the hybrid markets like Phoenix. Um, what else? Property taxes out here. This is another reason why, Indiana is considered one of the top five most landlord-friendly states in all of the US. This is one of the reasons why. Property taxes are really low. Insurance rates are reasonable. And they've got landlord-friendly laws when it comes to eviction and stuff like that. And so you kind of get the best of both worlds here. You get the renter pool from Chicago. You get the Chicago income in the renter pool, but you get the landlord protection and benefits from Indiana. And that's definitely one of the reasons why we like this. In
And Pete,
terms
I'll
of,
stop you there too. I know on our last webinar, folks were talking about the insurance and talking about some of the things that can happen in this market, whether it's snow, whether it's, some of these things that happen. We actually just had a large rainfall, maybe about maybe 2, 3 weeks ago here, where some areas were completely flooded. And I'll tell you, Cherville's drainage system, what they have to offer here is excellent. There was nothing wrong with Woody Creek. I know folks had some concern with the creek there, but it drained perfectly. We had no problems. There was nothing going on with our roofs. Everything was in tip-top condition. So we don't have to worry about anything when it comes to floods or rainfall.
yeah. I mean, when we talk about we've already executed our business plan, and proof of concept. And there you go. We've already been through a pretty bad storm and had
Yep.
no damages from it, no issues, right? Cool. Housing values, just comparison purpose. We bought the property, price per unit was 229,000. Median condo value is 272, and median condo square footage is probably not as big as ours, 1350 square feet. So these are not condos, they're apartments, but still they feel and live like a large, nice condo. Migration, we talk about increasing demand. Well, one of the things we saw that was cool, just kind of to prove what we've been seeing otherwise, is U-Haul every year puts out a ranking in terms of where their one-way U-Hauls are going. And it's not an exact measurement, but it's a good indicator of where people are moving to and from. And again, it's not precise, but a lot of big investors look at this and just use it as one of their tools. And Indiana ranked number 8 last year. Number it moved up on the chart 27 spaces to number 8. So it was just one more thing that we saw that proved that in-migration is up, demand is rising, and you'll see in a little bit that supply is really not increasing too much. And the unemployment rate here is really low, 2.9%, lower than the average of 4.1. This stat was created, maybe earlier this year, I think, when we found this. I wonder what that rate is now. So as we were doing our due diligence, we outsourced, we hired Colliers to do their own third-party local market study on Chicago and the submarket. And this is what we got. This was an expensive report that we paid for, but again, we just wanted that validation that everything that we were seeing and coming up with was correct. And so they put together a pretty extensive report. This right here, this Maryville, Portage, Valparaiso. So this is kind of like the region where we're in, fairly small region. How many square miles would you say this is, Mike, or like radius? Is this a 5 or a 10 or 15-mile radius?
Valparaiso's, I'd say probably around 30 minutes from here. So I'd say that's probably a 30 to 40
30,
square
40
mile.
minute drive
Yeah.
radius. Okay, cool. Well, so this whole region for vintage 2010s, which this property was built in 2012, occupancy is at 96.4. And this was, where's the year that this was? Maybe this was just 2024, but
Yeah,
it
this is
changes by the
2024
vintage
Q3.
here. What's that? Oh, here we go.
2024
That's
Q3.
where it was. Yeah. So towards the end of last year, right? Average 96%. Okay. Another one here, general vacancy conclusion, 2024 quarter three was 4%. The prior year, 4.3%. The average vacancy for the last 5 years in this area is 3.6%. Right. And so Collier's market study basically came to the general conclusion that 4% is a fair estimate for this area. Historical supply and demand analysis from the submarket. Again, occupancy percentage, 2024, 96%. Absorption is 43. So there's just not a lot of new supply. Under construction was 571 units. Near-term deliveries, 500. It's very minimal. Very minimal. This one's the submarket occupancy, rental rate, and trends. And this is comparing to Chicago. Okay. So over here it says versus Metro. There's a whole nother document that we have available that you can see. This is kind of just the snippets, but this compares our submarket to the Metro total. And so the green dots indicate that our submarket is performing better than the Metro, which is Chicago. So all of the big regional stats that come out are based on Chicago because that's the big metro in the region. We're the submarket. But this here indicates that our submarket is outperforming the metro and the metro is outperforming most of the other metros in the entire United States. So it's a good indicator when everything's green, right, Mike?
That's right. That's so strange that you're saying that because it doesn't happen in Arizona that way. But man,
Yeah.
it's rock solid.
Right, right. So if we look at by vintage, we're in the 2010s. This is the year period, right? Occupancy, um, 2019 was its lowest, but 5 to 3% vacancy ever since. And then comparing to the metro, it's a little bit better across the board. Okay, so again, just to kind of recap, it's super investor friendly market, which we liked. I never would have bought this property if it was in Illinois. Illinois is not a great state to buy in if you're a property owner. The fact that it's right across the border, we get the best of both worlds. It's got fast eviction processes. We haven't needed to, and I don't think we will, but if we do, it's nice to know that we can get them out quickly. Um, There was even a thing that I saw in the state laws that if a tenant damages significantly your property significantly, it allows immediate eviction without notice, which is cool. I don't know how often that goes into play. We've got some pretty good tenants that are paying 2,500 bucks a month. It's not like we're dealing with low end people, but anytime you have that as leverage, it just makes your case a little bit stronger as a landlord. Low supply, high demand. We've already talked about low property taxes, eighth lowest in the nation. Just a great place to invest. This is just a bunch of more information that I pulled from ChatGPT, honestly, about the market. But basically, what it came down to, and I encourage everybody to use your AIs to do your own due diligence. But what it came down to is this is a stable market with growth potential. Isn't that, that's what I look for in investment, stable with growth potential, right? What else could you ask for? Okay, financial overview. So here's our pro forma on the property level. This is the projected returns. Now, disclaimer, no investment ever produces exactly what the pro forma looks like, at least in terms of a real estate investment. It's always going to be above or below. But we project this out pretty conservatively. I've done a number of projections myself, Mike as well, and we always try to underpromise and overdeliver. We put our own money in these. We're not looking to oversell anything. We want to be as realistic as possible. And we've got another slide a little bit later on where we'll talk about how conservative our assumptions were and why we think we're going to over deliver on these. But um, these numbers where we're projecting, an average annual return of 30% and an average cash on cash return of 10% are pretty darn solid when we consider how conservative we were in putting this together. An equity multiple almost three times. So when we looked at these numbers, combined with all of the market stats that we saw, the trends moving in the right direction, the supply and demand moving in the right direction, and all the risk factors were just really low for us. But this growth potential on a conservative manner is really high. It was a no-brainer for us. Um, Anything to add onto this, Mike?
No, you hit the nail on the head. I think being that conservative and understanding what we're getting today, we're killing the numbers right now. If we stay on this track for the course of 6 years, oh, we're gonna really kill these numbers. Absolutely.
Yeah. All right. So we bought the property for 5.5 million. The seller financed 4.4 million. The terms of the note were 6 years, interest only, starting at 3.25. It's a step up rate. It's blended at 3.88. We actually have an option to extend this by an additional year for a small fee. I think it was a half a point, maybe, or maybe a point at the most. So we could stretch this into a seventh year if it made sense for us. And one of the other key terms that we negotiated into this seller finance note is that it is assumable. So if we get a buyer that's come along in year 2 or 3 or 4 and willing to pay a great price, and and it makes sense for us to for him to take over this note, we can assign it to the next buyer. So that's a pretty cool thing that gives us another just more options on the exit, right? In terms of equity, we put 1.1 down, and then the rest is CapEx and reserves. So we've got a big project ahead of us. Again, another breakdown on the numbers. Minimum investment is 50,000. We've got three different investment tiers, which we'll get into. We are expecting a 5 to 7 year hold cycle. So these are the three different investment classes, each with different return profiles, starting with a $50,000 minimum, which comes with a 5% preferred return, a 60/40 split, excuse me, till a 15 IRR hurdle, and then 50/50 thereafter. And then Class B is a $100,000 minimum with a 6.5% preferred return, 65/35 split until a 16 IRR hurdle, and then 50/50 thereafter. The Class A has a 250 minimum with an 8% pref, 70/30 split until a 17 IRR hurdle, and then 50/50 thereafter. And so we have these hurdles really so that, what that means is if we over deliver on our pro forma and we really knock it out of the park, well, if we deliver, a 25% IRR hurdle in here, it just means that we get to share a little bit in the upside, which I think is a good strategy, whether you're an entrepreneur or an investor or you've got employees, because really we're the operating partners. We incentivize us to knock it out of the park. That's what it is. So we're working hard, right? And then we've got a couple of bonus options for bigger checks. Okay, and so if for $500,000 investors, we're bumping up the preferred return to 9%, and for $1 million investor, we're going to bump it up to 10% pref and 5% of the management equity, aka GP promote. All right, and so that's just to incentivize the bigger checks. But again, we set this up to where more people can have access to the investment. We can invite our friends and family who have 50,000 and want to get a seat at the table and participate. But we also wanted to bring in people that could potentially be like a micro JV partner. And so what does that look like in terms of dollars and cents? We've mapped that out here into what that might look like. Again, this is if the returns hit the pro forma exactly, which is not likely. But if it does hit exactly, this is what it's going to look like. A $50,000 investment will yield a total profit of 58. So you get 108 back. This is after the exit. So it's a little bit over a 2 times multiple. IRR is a little bit over 15. Average annual return just under 20. Cash on cash return about 7. Total return on investment 116. Okay, and then if we bump this up to 500,000, what does that look like? The investment is 500,000. The profit is 722. Equity multiple is almost 2.5. IRR is just about 19. Average annual return almost 25%. Cash on cash return 11.5. Total return on investment 145%. So it's set up to where the more money you invest, the higher return on your investment you'll get. All right, and then we don't have $1 million shown here, but that would be even higher.
And Pete, I got to tell you, man, those are some good numbers. You look at
We
some other
said,
deals, those are good numbers. And if
oh, totally, yeah.
we worked our butts off to get this deal, and these numbers look great, especially with the bigger total investments. And let's uh, let's get your capital on this and get firing away so we can start moving on Woody Creek. This is great. I love these numbers. I mean, we're getting double return, almost 2.5 equity multiple. That's huge. That is
Yeah,
awesome.
well, when you think about it, if you're an investor and you've got 250,000 to invest, you can easily go out and buy a single family home, right? And so you could maybe 250,000, you might be able to get a $600,000 home in Phoenix after you put your down payment in and do a little bit of upgrades. you know what? A $500,000 house, you're going to be able to rent that for probably 2,000 or 2,500 bucks. And your mortgage payment is going to be right there. You're going to break even or you're going to lose money every month. And you're going to hope that it appreciates over time. You're going to hope that you don't have to replace the roof. You're going to hope that you don't have to replace the AC unit, right? You're going to have $250,000 sunk and you're going like this. Please go up in value. Please
Exactly.
go up in value, right? Whereas the deal that we have here, there's really low risk and more upside potentially, right? I mean, this is really it just trumps. We set this up so that this was a lot more lucrative and trumps anybody wanting to go buy a single family home and mess with it on their own. You could do this as a passive partner, not have to do anything and make better returns than you would going out and buying a house, right? Okay, and so hey, you know what? Real estate pays us four ways. Four ways. That's why I love it. I mean, they compound. You get every property you buy pays you four ways, and you start buying more and more properties. All of a sudden, you get a lot of income streams. So what are those four ways? Number one is cash flow. Okay, we talked about that. Like this property is going to yield what? 10% cash on cash return, roughly 7 to 11, depending on your investment. You get appreciation, which you recap at the end. You get depreciation, which is in the form of tax benefits, and you get principal pay down, which the tenants pay the loan down. Now, in our case, we got an interest-only loan, so there's no principal pay down. It's actually instead it's distributed. What we have is better because generally you have a loan, you have to wait to get the benefits of that until you pay off that loan. But in our case, since it's interest only, it comes out in the form of a distribution along the way. So it's much better. But the tax benefits is huge, right? And I haven't paid taxes in years because I keep buying real estate. And so we've already gotten a cost segregation study. Well, not done. We got the estimate. And for the property, there's going to be about $1.7 million in depreciation to share amongst the investors for the first year, this year, 2025. Now, different investors, depending on their financial situation, can use depreciation differently, right? And so this is assuming everybody can use bonus depreciation and can offset passive income or is an active real estate professional. Now the numbers are likely to change, but in that case that everybody can fully benefit from it, this is what that means for your investment. So if you put in 50,000, you'll have roughly 2.3% ownership. That means an estimated $27,500 depreciation, meaning reducing your taxable income. So if you have $100,000 in passive income, this would reduce it by that amount. And then if you're in the 35% tax bracket, this is the actual financial benefit that you would have this year. Okay, if you invested 50,000. 250,000, it's a little bit more. You've got more ownership. Okay, you've got more depreciation, and then you've got more savings. Now, there's a lot of variables here, and it's going to depend a lot on the individual investor's tax situation, and it depends on your tax bracket. Now, the reality is a lot of investors can't use the bonus depreciation because bonus depreciation typically only offsets passive income. So if you have active income only, you can benefit from some depreciation, not all. What that usually means is the cash flow that this property will kick off to you can probably be offset by the depreciation. So just hypothetically, let's say you get $5,000 a year in cash flow. The depreciation from this would likely offset all of that, if not more, meaning you're not paying taxes on that $5,000. Okay, so that's kind of like the worst case scenario. The worst case scenario. It's real income and it's paper losses. And if you were to compare this to like a stock dividend that paid you $5,000 in dividends, well, on that side, you're getting taxed on those dividends. So you're going to be paying 35% taxes on that 5,000 earnings, meaning you're really going to be making what, like probably 2,500 or 3,000 after you pay taxes on it. That's not the case with real estate. That's why real estate is generally considered a much more favorable investment. Now, if you are a real estate professional or you have extensive other passive income, that's where you can really benefit from the bonus depreciation. What's likely to happen is a handful or a small portion of our investors will be able to, and that means there might be more to share, more upfront cost to pay for the study, which the total study costs 10 grand. Okay, it's not much in the grand scheme of things, but then it can get split up between those that use it, and then the other investors who can't use it will get their share of the straight line depreciation. So if you have any questions about this, I'm happy to do a one-on-one and talk about it, or even bring in my CPA or your CPA. Any of this, if this is a concern to you, definitely want to talk about your CPA, talk to your CPA about it. And I also have a wealth management company that I work with that can help offset active income in other vehicles. And so if you want to buy real estate and you want to offset active income, there's a way to do that. Just reach out to me and I can put you in touch with the right people. Mike, anything else to add to that?
No, you covered that great. I'm sure you need a drink of water after that one.
Uh, okay. Let's talk about some of our assumptions when we were penciling this out, right? And so when we say we were conservative, this is what that means. We really just anticipated a steady 3% annual appreciation on the property value. We bought this year in 2025, which I think is most people will tell you they think is somewhere at the bottom of a cycle, right? So if we goes up 3% per year, it's a pretty conservative ratio, especially considering that stat we looked at before. The market has appreciated 5.5% for the last 10 years consistently. That's a long time. So I think we'll be, I think we'll over deliver on that. That's not really in our control. We'll see. Vacancy rates, we factored in 23.5% for the first year while we renovate the units, which we'll see how that comes in. I think it's conservative. And then we decrease our vacancy to 6%. And every stat that we saw, even the third party market studies showed 5 or 4 or 3% was more likely. So I'm guessing we're going to have lower vacancy than we projected. Um, what else here? Yeah. So what does that mean? 6% vacancy is 1.5 out of the 24 units vacant at all times. I just don't see that happening, honestly. Turnover ratio, 75-day turnover time per unit to get them renovated and released. Really, we expect it to be pretty quick. Mike, what are we doing right now, turnover time? What's it looking like?
We just did 2 units in I'd say probably less than 60 days.
Those are the biggest ones, though. We also did a couple of quicker turns, and how long did those take?
Those took 2 weeks.
Yeah, some of them took 2 weeks, right? So it depends on how much work we're doing. Some of the units need a little bit more than others, and we're also delivering units with different finish levels to kind of test the market, right? Let's see. Upfront reserves built into the capital stack is 143,000 bucks. It's a lot, so we just never want to be financially strapped. We don't need that much, but it's good to have more than you need. And our renovation budget is 30,000 bucks per unit, and we're coming in nowhere close. Our most expensive reno came in at like what was it, 24,000.
Yeah, about 24 to 26 in that range, depending on what we're doing with the unit.
That's with all new cabinets and everything. But we did some other cheaper ones that came in under 15,000 as well, right, Mike?
That's right. Yep.
Yeah. Yeah. All right. We are going a little bit longer than I expected time-wise, but I'm just going to keep going because I think this is good info. Mike, where are we at here?
Yeah, so this is right near the property. So this is just the neighborhood right across the street. Very affluent neighborhood, Stone Gate, I believe it's called. We're talking multi-million dollar homes, all brick homes, really nice. I mean, very quiet community. As Pete mentioned before, I just drove through there yesterday and there was ducks crossing Stone Bridge. There it is, Stone Bridge Estates. Yeah, just ducks crossing across the street there. Had to hold up and let them all cross, but it's just absolutely beautiful out there. Pine trees, flowing water, feed area. But
I
just
think
at the
this is
stop
that
sign.
park that I was mentioning before, right?
No, that's just a wooded area. If you hang a left here at the stop sign, the park will come up on your right.
Oh, okay. And what are these properties, Mike?
Which these here, these are the comparables that are just down the corner. On the left side, those are kind of the lower tier. Similar to Woody Creek, they're 4 units in each building. And then on the right side are more of the upper scale in that 2,300 range. Those are more of our competitors, but they have a little bit more of a lift to them. They're brick, a little different than Woody Creek, but we're able to compete with them. So we're
Yeah.
getting the rents just like them. So
These are
um,
renting for 23 to 2,400. We saw our units and we're like, well, we should be actually renting for more than those.
absolutely.
What are we looking at here, Mike?
Yeah, this is the town. These are the amenities here. We've got the local Wendy's. We've got the Home Depot that's just around the corner. There we've got on the bottom right, we have the Menards and Lick Go. They've got a bunch of, smaller retail shopping centers there. You've got Menards. Menards is a huge, that's one of the largest, I think, Menards that's there. It's got two
That's Home
stories.
Depot. But
Yeah, just I'm talking about on the right side there on the bottom.
oh, oh, okay.
Just to the right of that stop sign is Menards, and that's one of the
Oh,
largest Menards in the area. They've got 2 stories. It's got an escalator that you can take up to the second story. It's pretty cool. They've got so many levels, so many aisleways for your home remodeling needs. So we're definitely taking advantage of them. Plus, they have rebates that they offer, so it's awesome. They've got
yeah,
dealerships just around the corner, car dealerships like Mercedes, Lexus. So it's the affluent area for the folks. And then just down the way, we've got nearby cities that have Whole Foods, that have Nordstrom's, and that's Munster, Indiana, and Dyer, Indiana. So it's rear right smack in the middle of everything that you need for the folks.
yeah. So
Now here,
This is Woody Creek. This is the
yeah,
property. Tell us what we're looking at on this drive-by, Mike.
yeah. So that's the garages. Those are the only separated garages from the units. That's it starts on that side, 1555. You'll see some trees there. We're actually doing some landscaping, trimming those back a little bit, cleaning things up, painting some exteriors, fixing the sprinkler system, and really taking care of the lawn. The lawn is absolutely beautiful and green right now. We've got lush trees that are grown in right now. But yeah, these are the all the shared garages for the units. Each building has 4 units with 2 garages. So there's your little walkway there.
Yeah.
And
So each building has 4 apartments, and each apartment has one garage. Just
correct,
there. Yeah.
correct. Yeah, and the tenants, this here's 1489, 1491, and most of the tenants, you'll see that middle walkway. It's kind of like you're a really close neighbor, and they're all friends. All 4 of those folks are friends, and they know what's going on in the community. They stay tight knit. They watch each other. They watch the community and make sure everything's going on because we get the reports, and it's great. Very good people, very good tenants. I haven't had any issues.
Cool. So this is the first unit that we finished. Well, it's not the exact same unit, but they're all very similar. But these are rented for 1450, 1500 a month when we took over. And this is what we did on the first one. You'll see it's all new flooring. We changed out the countertops with is this quartz, Mike? Or is
That's
it
courts.
yeah,
That's right.
quartz.
Pebble Creek
We did a
courts.
beautiful paint job. We put in all new light fixtures. Some of the units are getting new appliances where needed, but not all of them. I'm assuming we got new sink and faucet since we did the cabinets. We did a little knobs there. This is just the kitchen. Um, this is another unit. And this one we didn't refinish the cabinet. So the first few units we wanted to deliver a few different spec levels at different prices to see what the demand was. When this one rented within 2 weeks, we knew we had something, but we already decided to try one without refinishing the cabinets. These were already really nice. And yeah, it might look better painted, but we weren't sure if that, two or three thousand bucks was worth it. So this one leased already for 22.95. And again, like these lights, I think we kept the original lights. So we're trying a few different things. Some of them we went through, we changed out all the fixtures. Some of them we were a little bit more selective. This might have been, Mike, was this the one we only spent like what, like 12,000 bucks on or so?
Yeah, I think this one's the least upgraded of all of them. I don't,
Yeah.
because typically we're going in and changing LED lighting, changing all the fixtures, changing even USB outlets, little things like that, just to have some of those upgrades. But this one, I think this one was the least, and we've got 22.95 that rented out for that one. So we were definitely surprised.
Yeah. We've got another one that's for lease right now for 21.95. That's low on the spec level. And again, we're trying like, do we spend less and can we come in maybe just a couple $100 more or less than that other one? And is the return better that way? Or do people really want the top level? So it's what we're finding is that it's nice for people to have choices too.
Yeah,
Uh,
and just to explain that one, Pete, this one was the versus the other one, and what's the difference there? This one is the lower level, the other
First floor.
one first floor, correct, and the other one had hardwood flooring, the luxury vinyl plank, and this one
Mhm.
had carpet. So there's the difference there. So that's saving us quite a lot of money
Yep.
um, on that feature.
The bathrooms, we're not doing a whole lot. We're just cleaning them up. We're trying to be strategic on our spend. We're not ripping out the tile. We're just cleaning them real good. Same thing with the vanities. I think some units, have we changed out the vanities in some units, Mike? Or
Yeah, we
just,
did change out the vanity and the vanity top, and we changed out light bulbs. We changed out
yeah.
some of
But we're not
the
spending
tanks.
a bunch of money in the bathrooms. We're cleaning them up.
No.
We're spending the bulk in the living area, on the flooring and the kitchen. And so here's a few of the new ones, right? That's the one that we saw before. Here's another one. Again, these are like the older lights. We didn't change those out. This countertop is the same for mica, but it's got new floors. It's clean. This one's this is another unit upstairs and similar situation. We didn't do that. So, we're cleaning them up real nice and the rents are going through the roof just because a combination of they were under rented before, not managed very well, and there is a demand, and we recognized it, and we're taking advantage of it. And so that's it. That's it. If you're interested, reach out. We've got the things in motion here. We're raising capital to finish the project. We've already closed on it. We just need more to finish it. We've started 6 units out of the 24. And so the capital is going to allow us to continue renovating the remainder of the units and have plenty of reserves in the bank. So if you're interested, it's pretty simple. We've got an investment portal with this deck and other information. You can make a soft commitment there, walk you through the process. It's pretty simple, but you do need to be an accredited investor, and there's a verification process for that as well. Um, that's it. Do we have any questions? Chelsea, have you seen anything come through?
Yeah, I do have a couple questions here for you. The first one is, how do you see migration and affordability trends sustaining rent growth in this area over the next 5 to 7 years?
Can you restate that question?
Yeah. How do you see migration and affordability trends sustaining rent growth in this area where Woody Creek is over the next 5 to 7 years?
Well, everything that we've seen says that it's trending in the right direction and it's not moving too fast. I mean, the Midwest is known for being kind of like a steady eddy, and the in-migration is strong, but it's not overly strong. The job growth is strong, but it's not overly strong. And there's no really very limited supply. And so, in my eyes, everything kind of seems to be like it's going to be a consistent trend. but I guess nobody can really predict the future. Mike, do you have anything to add on that?
Yeah, I'm in the same boat. Just being from this area, I know I didn't mention this early on, but some of the guests are probably asking, why did I go back to Indiana from Arizona? So I am originally from the Midwest, and I know everything that the economy is about here and what's happening. And right now, I mean, you've got your affluent areas, you have your doctors, there's a nearby hospital, you've got your nurses here, so it's a very strong employment force. You do have your blue collar, you have your steel mills here. So this is long-term employment, stable employment. Do I see anything happening in the next 3 years? I'm pretty confident that it's going to stay stable. The rents are only growing. The competition's only getting tougher, as you see with myself, trying to find some housing situation for myself and the family. I don't see any slowdown, especially with the build out and the construction here too. So we just have a lot of people moving in from Illinois. I've read some articles just recently over the last week of the growth in nearby cities here. So it's constantly exploding from the Illinois traffic. So I see big booms coming here in the next 3 years. But hey, nothing's guaranteed.
Okay. Anything else, Chelsea?
Yeah, I have another question for you. For someone looking at the 1 million plus participation, can you explain how the enhanced preferred return and micro JV options work in practice?
Well, in practice, it's pretty simple. I mean, you would be a Class A shareholder, which is the 250 class, and then the added preferred return would jump from 8 to 10%. So that extra 2% actually comes out of me and Mike's pocket. It doesn't come out from the other investor's pocket. And then we would bring you in with 5% of the management equity. And so it's pretty simple. It's just getting a separate legal document put together, and we want to make sure that we're aligned. Um, and that we're a good fit before we decide. Like that's not something that just anybody can do. We want to make sure that we're both comfortable with that type of arrangement beforehand.
All right. I have one more question for you. It looks like the rest of them you answered throughout the presentation. So you kind of began speaking to this, but how do you ensure alignment between you as the operator and a large anchor investor over the full hold period?
How do we ensure alignment? Well, I mean, I guess really it starts with the upfront conversations and making sure that we all want the same thing and expect the same thing. Kind of like Mike and I early on, we really just made sure that we were the right fit for each other. And so an anchor investment, somebody's going to put in a lot of money. Yeah, I mean, we need to make sure that the expectations are in line with reality and that we want the same thing, which I think is everybody wants a success, right? And that there's no major surprises. Any investment can deliver surprises, but I think it's just a matter of really getting comfortable with each other and probably having more than one conversation before that happens. Anything to add on that, Mike?
Pete, I just want to say this is just a follow up and closing. This is a really sexy deal. Being in brokerage for the last 10 years, and I know there's some guys out there that are looking for a deal like this. You mentioned it, Pete. Four deals of, or excuse me, four streams of income. I know you're on podcasts. I know you're writing books about how to get out of the rat race, and this is the way. We've got to we have to understand, at least what I've learned through my career in commercial sales is, I was getting commission, I was selling deals and trying to figure out how to get out of the rat race. And here we go. We've got Woody Creek. We're earning four streams of income, and we're gonna kill the numbers that we see here that we just projected. Twice the income, and this is the way to do it, guys. Jump on board with us. Space is limited, and let's crush it together.
Yeah. Well, this is, when you make a real estate investment, it's a wealth engine. So you want to have your income engine, which is your job or your business or whatever produces the active income and, make more than what you live off of and the rest you want to invest, whether it's real estate or something else. I like real estate because the four ways the four financial benefits compound over time to be something pretty meaningful. And this is a really good one. So cool. Well, definitely, if you got any other questions, feel free to reach out to either of us. You can scan this code or just contact me directly. And we look forward to chatting with you.